Welcome to the daily update, where I'll go over the action in the market for Thursday, December 26th, and we'll see how things look for Friday, December 27th. Pretty sleepy day. Small caps showing a little bit of hope there. They actually outperformed the rest of the market, but the S&P 500 and the main major indexes really didn't do all that much. There was not a lot of conviction. We are still seeing a subtle improvement with things. Some of our indicators are actually looking a little bit better. Even though we closed with an official down day, we were virtually unchanged. So, under the surface, we're seeing a continuation of these improvements. The market is still vulnerable. We're well below average with volume. That's probably going to continue for the next week or so until the beginning of the new year. But we're also in a period of positive seasonality with the Santa Claus rally supposedly in gear right now. And quite often that will lead to a more positive bias. Before I get into the video, I want to wish everybody a happy Kwanzaa from December 26th through January 1st. If you celebrate this, I hope you have a wonderful experience and time doing that. Okay, also, there's a thing called the SPX Investing Program. It's up, it's going for about another week or so, actually less than a week now. It's still free. You can go check that out. I'll be locking it down in January. There are additional videos that I post there. You get immediate access to the videos as they are available. There's a link that'll take you to the website as well as to a video. You can send me any questions here with an email address. Feel free to check that out and see if it'll be helpful to you. Also, the daily video is still the real foundation of the analysis that I do. We're getting close to the weekend now. I'll be preparing the outside videos, but they're all meant to tie into the daily videos. All right, let's go back and talk about what happened and then look at some charts. We did have a lower open. We drifted lower before the market opened. Europe's pretty much closed right now, so we didn't get much of a key off of that. But we just drifted down, down, down. That led to a lower open. We did find support at the daily pivot at 6,021. Then we bounced up off of that and actually got above the unchanged level, so prices turned positive. And we chopped above and below the unchanged level, and we closed just a little bit down, going right at the end of the day. We were down 0.04% on well below average volume. We are still positive in the short, intermediate, and long term. That's based on the moving averages. We're still above the 20. That's the short-term moving average, 50, and of course 200. So that is still positive. We're still seeing some mixed signals when we look deeper under the surface. Interest rates actually came down just a little bit, not a real big change in that, and we really didn't get any economic data that talked about inflation. We did get jobless claims and continuing claims that I'll go through here in just a moment. Nothing really geopolitical that's having an impact on the market right now, even though there's lots of things that are happening. Small caps did outperform in Thursday's session, and that's kind of a self-fulfilling prophecy. This is one of those times when small caps typically do well, but they had not been doing very well at all. So we're going to have to see if this can continue. We're still above 6,000 with the S&P 500. The VIX is still under 15. It ticked up a little bit on Thursday with the slight down day, but we're still dropping from being well above 20 just a week ago. We still have a confirmed Hindenburg-Ullman, and we're still looking oversold with the 20-period simple moving average study. And that's something that we're keeping a close eye on to see if there's some real strength coming back in, and it'll be picked up by this particular study. It's looking a little bit better. It's bouncing up, but it's still not really showing any strength, and it's still pretty extreme negative. In the intermediate term, we still have one area, the PMO studies. The buy signals are still extreme negative, but that's showing a little bit of improvement with the other studies on that chart. And then our 50-period simple moving average studies. It's bouncing up, but still not showing any real strength yet. Then the Fed did come in and they cut rates 0.25%. That happened already, and the market is still anticipating a soft landing. But now the Fed has come out and said they're probably going to pause these rate cuts, and they've increased their inflation outlook. And that was the cause of the big down move that we saw a week before Christmas. The dollar was down and interest rates were also down. We're at 4.58% from 4.59%. So not a big change there. But when you look at interest rates by themselves, they're still really high. They're really up from where we were just a month or so ago. And that has been really pressuring stocks. Sentiment is still negative. We ticked up one notch. And the general consensus or context of this is that we're improving. There's people are feeling a little bit happier about things, but we're still negative right now at 35, where we had been at 34. We're still looking negative with our trend. Now, the red line is coming down, the green line's coming up. We're showing a weakening trend right now, but we're still trending since we're above 20. And I'll show you that chart there. And because we had the slight down day and spent it above and below the unchanged level, I have the bias at mixed, and I still have our momentum at mixed to positive because of the positive seasonality, because of the subtle improvements that we're seeing in the charts, and because we recaptured the 20 period moving average. You could lean a little bit more positive, but because volume is so low right now, the market is vulnerable. A big seller comes in, and that could really have an impact. Economic reports that came out. This actually showed some strength, down a little bit with the weekly jobless claims from the previous week that had been at 220,000, came in at 219,000. That's not a big change, but it's also less than what they had expected. A lot less at 232,000. So the market was already pricing in the idea that 232,000 initial jobless claims would come out. And then that number came in much lower, and that was showing some strength. And that kind of spooked the market a little bit there. But then on the other hand, the continuing claims are going up. So we're seeing folks not getting laid off. That's going down. But folks that are unemployed are staying unemployed, and that number continues to go up. And here's a chart to show that, where we're going down here with the weekly jobless claims, but the 4 week moving average is still going up. So we're seeing a little bit of a contradiction there. Where we're seeing more weakness coming in are the continuing claims continue to go up, and we're starting to turn back up with the 4 week moving average that way. And then to give it a little bit more context, I don't put the moving averages on here. This chart's messy enough as it is, where we're going up with the continuing claims, coming down with the initial claims, and then the latest unemployment rate that we received. We'll get another one right after the first of the year, and we'll see how things adjust according to that. Then looking at the price estimate for valuation estimates here, and just looking at the PE ratio, looking forward, and then that's based around the earnings. What's the S&P going to end up doing according to that? And we're still very, very overvalued right now, even looking forward. Now, we can go years and years at a time and be overvalued on a historical basis when you look back at previous earnings. But we're still there right now, and this is okay. What's the PE ratio going to be depending on what the S&P 500 does? And nobody knows what will really happen. People think they do, but nobody really does. And then the truck tonnage index, we're still seeing a disconnect here. The purple line is the S&P 500, and it's just continuing to go up, not too far off of all-time highs. The truck tonnage index tends to move more hand in hand with what the S&P 500 is doing. But ever since the whole COVID crash and the switch that we've seen in the economy, this has started to level off as stocks have still been going up. So we're seeing a bit of a negative divergence there. And the Magnificent Seven, what do they contribute to the returns? And this breaks it down based on the different seven stocks here, and then what they have as far as an impact. And it's just kind of an interesting graphic here. This is why we look at charts here of all of these stocks. I also include Netflix in the whole mix as well. And this is why we pay attention to them, because they have such an impact on the S&P 500. Then 10-year treasuries, fair value model here. The actual is actually getting a little bit above the model fair value a little bit here. We'll have to see. It would really help stocks a lot if interest rates could start to come down, and they're just not really doing that. We're just down one tick on Thursday. The dollar remains the dominant reserve currency. I know there's a lot of talk about other countries rearranging things and all of that. But for right now, anyway, the US dollar is still the main currency in the world, and that's why we do follow it. The performance gap between US and Europe in 2024, where here we're showing in blue the S&P 500, and this is what has happened in Europe. They're not seeing the follow through. Of course, this goes back. The elections were actually last spring, and then what the performance has been since that time. And we do keep an eye on the European markets because sometimes the US and European markets will play off of each other. 10-year real treasury yields, which means we take inflation into account. So even though we're higher than that, we're up into the mid four range with the 10-year yield by itself. When you calculate inflation into that, we're at 2.3%. December losses leave treasury market near flat for the year. And I go over this. I look at the year to date, and we're coming down to the end of the year. And bonds there was a period of time where they went positive based on price, but for the most part, they've spent all of 2024 negative based on price. And then a few charts I ran here. A lot of talk about tariffs with the new administration coming in, and a lot of people are talking about that. They don't know what the impact is going to be. Is it going to be good? Is it going to be bad? So people are discussing this, and this is just what Bloomberg came up with here based on AI. And going back a year ago, now this is one of the perma bears. I really don't even listen to this guy. He's been so wrong, and he tries to scare people so much. It's Harry Dent is his name. That I read a few of his books a few years back, and okay, there's some logic in what he's saying. It just what he says ends up not happening. And so he's lost all credibility with me. But there are still people that pay attention to him, and what makes me angry is people think that this guy knows what he's talking about, where he's wrong much more than he's right, and he scares people, and then they adjust things based on what he says because they think he's an expert, and they end up missing out on a lot of opportunities. But this is what he said a year ago at the end of 2023 that 2024 will be the biggest crash of our lifetime. And he's probably saying the same thing for 2025, but I don't know that for sure. He thinks that we're going to have an 86% decline. Well, we're up between 25 and 30%. Now, he's got what, less than a week left for us to crash, go down with all the losses that or the gains that we've seen in 2024, and then decrease another 86% after that. So I guess, there's still hope that he could probably be right. And it, and then even when he says things are going to fall apart, what he recommends doing would make you lose even more money, getting into certain kinds of investments that if we do really go down with the market, those things that he recommends also are going to go down in value, and they're really not defensive in nature. But anyway, you may have a different conclusion about this guy. You may actually, follow him. Every once in a while, I'll see one of his videos on YouTube, and I tried to give the guy a chance. I've read a few of his books out there, and then I kind of followed him along. And there I'd go to his website and things like that. But then as I saw what he would say over time, and it was so disconnected from what really ended up happening, I just said, forget it. Okay. And this kind of bears it out. A year ago, he predicted this, and we've done just the opposite. And there's other perma bears that I follow. And yeah, I rag on those guys a lot because the market goes up a lot more than it goes down. But yet for him and these other guys out there, it's always doom and gloom is just around the corner. And you could say that about every day, but when you take a bigger picture look at the stock market, it tends to perform well, but it also goes through some very difficult times. And that's what I analyze here and try to see things happening before we get into the difficult times and then to be able to take advantage of the good times. All right, then new home sales. It's actually cheaper right now based on this chart to go out and buy a new home than to buy an existing home. So you want to get a new home? It's actually a little bit cheaper. Okay, then strategists tend to herd with year-end market forecasts. Nobody, the people who think for themselves, they come up with the crazy predictions that aren't even going to be true, which is too bad because thinking for yourself is what really makes people unique and what makes them valuable. But most people, when it comes to looking out into what's going to be happening with their forecasts, They tend to all say about the same thing. All right, let's go back and look at the intraday chart. Really sleepy day, a little bit lower open. We did set some support here at the daily pivot. We came up, went positive, but then we just chopped above and below the unchanged level, and we were positive until the last 10 minutes when we dripped down a little bit and actually closed negative. And not much of a change here in the initial overnight session. We were more positive with the futures when they first started to trade again, but then we dropped off and then started to come back a little bit here. And then we went into the cash session and showed a little bit more of an improvement there. This is still positive. We're still seeing the blue line above the red line. Growth on an intraday basis is outperforming value, and that's underlying strength that as long as that still holds together, that gives us a more positive slant. We want growth to outperform value. This is still looking good. If you go back to the end of November, way over here on the left now, the intraday chart of growth to value for the S&P didn't do all that great in Thursday session, but you take the bigger picture look here, and it has been doing pretty well. Then we look at the end of day charts. Growth was down where value was up, so our ratios will take a bit of a hit there. Growth was up less for the mid caps and it was up less for the small caps. So this is what we've been seeing under the surface. You look at the small cap index, which has just been coming down ferociously here, but the growth to value ratio for the small caps has been holding up. Now it ticked down a little bit, but we actually saw enough of an improvement here to see a recent golden cross with this ratio, and that's under the surface positive. Seeing pretty much that same thing with mid cap growth to value, positive trend with this ratio, even though the index has been under a lot of pressure. And we're still hanging in there pretty good with S&P growth to value as well. So this is under the surface that could be positive. We look at a growth versus value ETF, ticked down a little bit in Thursday's session, but still coming out and breaking above this previous high. That's still looking pretty solid altogether there. And discretionary to staples has been doing very well also. So these are underlying positive things, but eventually we're going to have to see follow through in price. It's nice to look at these under the surface type of things, but ultimately it has to come through in price. Large cap growth down just a little bit here, but still holding up quite well. Looking at our trend, we are still declining with the ADX. We're below the moving average, and we're just starting to break down below 20 here in the intermediate term. Also breaking down below the moving average, and this is suggesting a non-trending environment right now. But we're still negative. The red line is just barely above the green line. Now, another day and a bit of a positive day, and we could switch this over to positive with the green line crossing above the red line, well below average with volume. Not really a surprise there. Still getting a pretty high reading with the Ulcer Index. This is another sentiment gauge based on closing prices. And we ticked up a little bit with the VIX on the line chart and the bar chart, but we're still below the moving averages here. So we've been seeing the VIX coming down, and the VIX of the VIX ticked up a little bit with the line chart as well as the bar chart. We're really rolling over now with the momentum. We haven't quite crossed to down as measured by the MACD, but we have been coming down here. If we still see things under control, the VIX could actually switch to having a downward momentum, which is more positive for stocks. And this is the seasonality coming up really close to the end here, where quite often we see the VIX dropping. Seeing a very, very high reading, about as high as we can get here with the skew index. The market is still anticipating some kind of a big move that hasn't really happened yet. And it's like folks are poising for that big move to happen. And this just continues to give us a very high reading. It could be to the upside, it could be to the downside. We've seen this thing moving around both on up and down days. And so trying to get a context with this can be pretty confusing. And you can reach one conclusion one day and a different conclusion the next. We ticked down a little bit with this one fear gauge and a little bit lower with this other fear gauge. So a little bit of fear coming out of the market measured this way. We did get the latest reading of the American Association of Individual Investors coming down. They're still positive. We're above zero, but they're really dropping off from what we had been seeing before. And not much of a change with the risk on to risk off ratio. Came down a little bit. But for this to continue to go up, that would be more positive for the S&P. And we declined a little bit with the equity put call daily chart. We're coming back up with the 5-day chart. Here's a longer term look at the 5-day chart. and actually ticking down just a little bit with the 10-day chart. So we're getting a mixed picture here and not a real conviction one way or the other. So we're seeing this more mixed. We are really coming down with the volatility risk premium. This is showing fear coming out of the market, and that continues to drop below the band. And our advanced decline line showing some improvement here. Now we've seen some really solid up days here, and so we're seeing an improvement based on price as well as volume, even though we were flat in Thursday's session. Seeing a little bit of an improvement here. More new highs than new lows. We're seeing a contraction of the new lows and a little tiny bit of an expansion of the new highs. We're still negative, but we're trying to turn up with the 5-day and we're flattening out with the 10-day moving average. This is slightly positive. We're just barely above the moving average here with accumulation distribution. So, and this is a little, it's not really correct. We're just barely above the moving average. The boom indicator down here has us quite a bit of ways above the moving average. Go with what you see with the indicator and moving average there. We are improving here with the advanced decline ratio. We're just barely going positive in the short term. That's the blue line, where the red line is coming back up, but still negative. So we're just barely positive here with the advanced decline line advanced decline ratio based on price, and we're already a little bit more negative. We're a little bit more positive after being negative with the advanced decline ratio based on volume. Not much of a change here, but actually a little bit of a decrease with the histogram going down with the chicken money flow. We're still pretty much flat to slightly declining with the 5-period moving average. This is more positive though, the Chaikin oscillator. We're crossing above the midpoint and going up, and sometimes this gives us a really good signal. So we're a little bit positive with accumulation distribution. We're a little bit weaker with Chaikin money flow, and we're turning positive here with the Chaikin oscillator. So we're not getting any uniformity, but we're seeing both signs of concern and signs of strength at the same time. And we're still negative with the vortex, but the red line's flattening out. The green line's coming back up. But taken together, this is still negative. A little bit of an improvement with the advanced decline line cumulative basis here based on price as well as volume. And this is still longer term negative. We're still declining with our 10-day average of the highs and lows for the S&P. We want this to start to go back up and get above this red line, which is 50, and that's the midpoint. Seeing an improvement here when we compare the S&P to the NYSE advanced decline line. They're both showing some positive action there. And we look at the cumulative advanced decline line on the NYSE based on price, still above the moving average, turning up, but below the moving average with the regular NYSE advanced decline line. And then another NYSE advanced decline line, which is calculated in a slightly different way, improving, but still below the moving average. When we break it out based on common stock, bouncing up based on price and volume here. Improving, but still negative with our advanced decline line studies. Turning up with all the indexes, but every one of them is still below their moving averages. And bouncing back up and right at the extreme negative reading here with those stocks in the S&P above their 20-period moving averages. And then here's the study. After getting down below 10, we need to see pretty quickly a real thrust up where we get above 70. We haven't seen that yet. And we don't want to get faked out either, like what happened in October 2023, where it looked like things were looking a lot better, but we never got up to the 70 level, and then we ended up making an even lower low based on price. What we want to see is what happened after that. At the end of October, we quickly went up above 70, and then the S&P did really well after that. So this is what we're watching for with this particular study. And we're still bouncing up but negative with those stocks above their 50-period moving average, and pretty much flat with the 100-period moving average study and flat with the 200-period moving average study. And a little bit of a decline here when we compare large caps to small caps. Small caps outperformed, so we're seeing this ratio coming down. But for the most part, it's been going up. If this can continue to go up, that would mean the S&P, or large caps, as here measured by the Russell 1000, which is the equivalent of the S&P 500, that would be more positive. And then here's our daily chart. It's really hard to see this still because we're getting ready for the new pivot points to start in January. On the bottom, way below average, with volume improving a little bit with our 20, 50, and 200 period moving averages on the S&P, and declined a little bit, but still above the midpoint with the Stochh RSI. We're flat but positive with the Williams percent R. coming above the midpoint with the CCI 14 and just a little bit above the midpoint with the CCI 20. So these subtle little improvements that we're seeing in the short term. And we were flat, but still showing some improvement with the short-term stochastic. We're still positive in the intermediate short term, still declining, but trying to improve with the long short-term stochastic. And the force index declined a little bit, but is still positive. And the condition of our short-term trend, we're still above the blue line and the green line. The more we can stay above that, the more these lines will turn up, the more positive that will be. And we're still above the simple and exponential moving averages here. We broke down below, but we were able to close back above. And we're still above the midpoint with the standard deviations chart. That's slowly switching more positive. Intermediate term, bouncing up, but still negative with the balance of power. We're positive here with the go, no-go system with the dark blue bars. And we're above the midpoint with our highest high value chart. Subtle little improvements here. The TTM squeeze, the lighter shade of red, starting to go back up. So that's showing a little bit of improvement there. And the standard deviation still giving a very high rating because it has last Wednesday, the Wednesday before Christmas's the big down day that we had. It's still in the calculation. Once that drops off, the standard deviation will probably really drop as well, unless we see another really big move. Improving a little bit, but still negative with the ease of movement. The Arun, it's on Christmas holiday. And crossing above zero with the S&P McClellan oscillator. This is one of these subtle improvements that we're seeing below the surface. We had crossed above zero after Tuesday. We're still going up after Thursday. And so we're starting to turn back up based on price with the summation index, and we're already continuing to go back up based on volume. So this is another sign of an improvement, but we're not actually full-blown positive yet. And improving, but still negative with the NYSE McClellan oscillator since it's still below zero. So we're still declining with the NYSE summation index based on price, ticking up just a little bit here based on volume. That could be a potentially subtle little positive sign. This is actually turning positive now, the Swenlin trading oscillator. And we're above zero and going up based on price and volume. So that's showing a lot of improvement. Trying to improve with momentum, but it's still negative. When we look at the PMO, turning back up based on price and volume, but still below their moving averages. The PMOs that were rising, it was just barely extreme negative, even though it was improving. We're no longer extreme negative here. Where we're extreme negative are with the buy signals, but we're trying to turn back up. But we're still declining with the PMOs that are above zero. And momentum is still negative, but trying to improve here in the short term with the slope oscillator. Also turning up at negative with the MACD. So still negative, but showing some signs in the short and intermediate term. We're still declining in the long term with the tricks and KST. The copy curve trying to turn up, but still negative there. The Sean trend meter showing a bit of an improvement and going up and declining, but still above 50 with the money flow and above 50 and, excuse me, above the midpoint, below 50, but improving with the ultimate oscillator. Still above the moving average with on-balance volume. We're looking better with the RSI, 14 period and 9 period, even though there wasn't much of a change there. The condition of the intermediate term trend, 50 periods, still below the blue line and the red line. We need to get above this to turn it more positive. And we're still above the simple and exponential moving averages, though. Here's all the moving averages. We're above the 20s and 50s. The 100 and 200s continue to go up. And we're positive for the second trading day now with the parabolic SAR. That's more intermediate term positive and a primary indicator. Still positive with the Elder's impulse system for the S&P. Ticking back up just a little bit, but still below the moving average with the bullish percent index. Improving, but still negative. Also ticking back up with the NYSE bullish percent index and flat after bouncing up a little bit with the NASDAQ 100 bullish percent index. And still wondering if these 20 periods simple moving averages of the open, high, low, close, that was kind of the high that we hit. So this may be acting as overhead resistance. We want to be able to clear above this little mini rainbow here to turn this chart more positive. And I haven't shown this in a couple of sessions, the Ichimoku cloud, we bounced down to the green cloud and we've been coming up. The one thing that's still negative here is the red line is still above the blue line. It would be more positive if the blue line could turn back up. We've been improving with the green line, but it was flat on Thursday. And we're still at the high end of this trend channel, wondering if that's providing overhead resistance. So we're looking more positive with the hike in ASHI chart as it measures trend, but we're still negative with the KG chart, even though we are pointing up. It's red. And we're positive again with the Renko chart, but we're negative with the three-line break. So we're getting a real mixed picture there. Long term, still bouncing up a little bit with the 150 and 200 period moving averages. So longer term is showing a bit of an improvement. It never went negative, but when these moving averages go up, that just means things are still remaining strong. We're keeping a close eye on this too with the swag NYSE breadth thrust. We came back above zero point 0.4, and now within 10 trading days, we want to get up to this red line. And that would be a valid swag NYSE breadth thrust, which could end up being very positive for the market. And we're negative with the mid caps and small caps in the short term. We're negative across the board with bonds based on price and now commodities based on price. Everything else is still positive there. And the areas that were strongest here, we had staples. That's a defensive area. It's nice to see the financials doing a little bit better. Healthcare is another defensive area. We saw discretionary being down the most. Communication was down a little bit. Tech was up just a little bit. You can see the percentage change. Nothing was up or down more than 1%, even more than 0.5%. So really slow day, lacking a lot of conviction there. And so we started off negative with the NASDAQ crossing below 20,000, then it crossed below 19.9, but the dollar ended up sitting at two-year high. It would end up closing down, but earlier in the day it was going up. And they did update this. We're back to looking positive with the decision point scorecard in the short term. We're still negative with the PMO, but they're positive with their trend model, and we're still positive in the long term. And seeing a little bit of an improvement when we compare the equal weight with the regular weighted version. Now, the fact that this red line is so far away from the bar chart shows that the equal weight has been underperforming, but to see them both going up is suggesting some improvement. And this is the ratio when we actually divide one by the other. With this really going up, that means the equal weight is underperforming, or to say it another way, the S&P is outperforming the equal weight. Even though we tick down just a little bit with this ratio. Still neutral with the diamonds when we look at the Elders Impulse system. Still below the 50-day moving average with the Dow. And it's hard to see with the pivot points coming up here, but we were just down a little bit with the NASDAQ. We were down 0.13% with the NASDAQ 100. Hard to make anything out with this chart. We're still positive, though, with the Qs when looking at the Elders Impulse system. The momentum for the NASDAQ 100 is improving, but still negative. The Qs are still above their 20-period moving average, so we were able to recapture that, and that is showing a sign of improvement. Small caps were up after really just coming down fierce. They were up over 0.5%, still below their 50-day moving average. Working off of that extreme negative reading, when we look at the Russell 2000 small caps, this is the RSI bouncing up. We're still below the midpoint, still below the 50-day moving average. The momentum for the small caps continues to be negative as measured by the MACD. Still neutral when we look at the small caps with the Elders Impulse system, coming up right to this pivot point here with the mid caps and still below their 50-day moving average, even though they were up 0.32%. Still neutral with the Elders Impulse system for the mid caps. The Wilshire ticked up just a little bit here, so it's still holding up. A broad market measure, we were up 0.06% with the total U.S. stock ETF, so we're still above the 50-day moving average. And the bank ETF was up over 0.5%, but we're still below its 50-day moving average. We want to keep an eye on the financial sector. And we were up here 0.25% and coming up a little bit above its 50-day moving average. And that's encouraging. We want the financial sector to be solid to help the S&P be solid. The FANG index was down just a little bit, but still holding up above its 50-day moving average. We're still right around this short-term trend line here, wondering if that'll provide overhead resistance. So we're going to see a real mix here. Apple was up 0.32%. Amazon was down 0.87%. Meta was down 0.72%. Microsoft down 0.28%. Google down 0.26%. We were down 0.21% with NVIDIA. See where the When these stocks don't really do much, the S&P 500 doesn't do very much. And Tesla was down 1.76%. Netflix was down 0.86%. Must have been some bad holiday movies. And we're keeping an eye on the SOX index, which is the semiconductor index. This is still looking negative, but we're above the 50-day moving average. We were down a little bit here, but barely. And we're down 0.03%. So not really much of a change there. We're just bouncing around here when we do a ratio between the semiconductors and the tech sector. We want this to really go up to be more positive. If we go down, that's going to be more negative. And we do another ratio between the semiconductors and the Dow, where this came down a little bit as the semiconductors underperformed the Dow. And then we look at the ETF. This is more positive. We're above the 50-day moving average with the SMH semiconductor ETF, and we're up at the high end and actually trying to break out of the rainbow with this same ETF. But we're range bound here. We need this to really break to the upside to be more positive. And still seeing a little bit of weakening when we compare world stocks with US stocks. US stocks are outperforming. Longer term, we have been seeing an improvement there with the correlation. The dollar's still up into the 108 range. It's up here, but it ended up being down during the stock market session. We were up just a little bit here with the 10-year. This is based on price. I have these in reverse order. That's why I'm confused. We were down a little bit with the 10-year yield. Then if I go back here, we were up a little bit based on price. So I had these switched. This is a concern. Home construction to the 3 to 7 year bonds. We're below the 250-day moving average. If this continues to fall, that could be negative. And then we're still holding up okay with our growth to value ratios. Qs to S&P above the moving average. Discretionary to S&P above the moving average. Large cap growth is above the moving average when compared to large cap value. Large caps, mid caps, we're still coming back down to the moving average with the small caps. So we want to keep an eye on this. Now we have another measure that looks at growth to value for the small caps, and it's been holding up okay. This one's actually showing a little bit of weakness. And we're still declining when we look at staples to S&P. That's positive for the S&P when this ratio is going down. So what's our outlook then? We're still in that period called the Santa Claus rally, which is the last 5 trading days of the year and the first 2 trading days. It started December 24th and it will go through January 3rd. The technicals are improving right now, and I'll go through my conclusion here at the end. We're going to get advanced international trade in goods, wholesale and resale. Okay, wholesale and retail inventories, not very influential. So the market's pretty much going to be left to itself in Friday's session. The geopolitical things, see if they have an impact. Not really that much. We're finishing out the economic calendar, and we already finished all the major reports for the week according to this calendar. Seasonality, not a real good day for December 27th. Neutral to negative with the Dow and S&P, flat out negative with the Nasdaq. So even though we're in the midst of the Santa Claus rally, going back over the last 21 years, this day has been much more negative, especially for the Nasdaq, where it's more neutral with the Dow and S&P. So we can't take Friday's session for granted there. And we're still finishing out the week after options expiration, where we're up 63% of the time, down 37% of the time. This is another chart that'll come and go here pretty quick. It says you really should believe in Santa. Well, let's see. Because if this was a done deal, these would all be 100%. They're not 100%, so it doesn't mean they always happen. It just means the probability is more positive than negative. And we're coming up here into the end of December. This is supposed to be, well, we did come down a little bit with the small caps, but the last few trading days tend to be positive. Can that really help the market? We also tend to be positive here with the S&P during an election year. And Friday is the second most positive day in 2023, and it's the most positive day in 2024. Here's the positive seasonality chart here. And this is the positive seasonality that if we go back to the election and then go out a year from the election, that tends to be positive also. And after this week, I'll probably drop this chart and just put it over in the weekly video. We're also in that positive period of time, according to Tom Bowley's research, from the 21st through the 31st is positive. And this is supposed to be the small caps just ripping off to the moon They're still on the launch pad, it looks like. So the warning signs, we are improving with our smart money indicators, turning slightly positive with accumulation distribution, slightly negative though with the Chaikin money flow, and we are positive with the Chaikin oscillator. So no real confirmation there. We're still negative with the advanced decline lines, but improving. But we're still below their moving averages. And we're mixed with the 5 and 10-day equity put call ratio charts. We are negative with the McClellan oscillator and summation index for the NYSE, but it is improving. And we're still negative, but possibly improving with the momentum of the S&P 500. We're also improving with the bullish percent indexes for the S&P, NYSE, and NASDAQ 100, but they're still negative. And we do have a confirmed Hindenburg-Omen, which is negative. The Vortex is negative, but improving. The moving average studies of those stocks inside of the S&P, they're still negative, but showing some signs of improvement there. The ease of movement is still negative. The ultimate oscillator is negative, and we're improving, but still negative with the momentum of the NASDAQ 100. The positive side, growth to value, discretionary to staples. This has been around for a while now. We're not just seeing 1 or 2 day wonders here. This has been going back a few weeks where we've been seeing more strength. And if you look at discretionary, it goes back to last August. We need to see follow through with price, though, to see that the market is taking advantage of this positive setup. We are positive with the McClellan oscillator and summation index with the S&P 500. And we're positive now with the Swenlin trading oscillator, the parabolic SAR. Now, the reason this is yellow is it's in between a primary and secondary indicator. Sometimes the Swenlin trading oscillator is a beautiful indicator and gives us a really good signal, but other times it doesn't. And so it's not quite in the primary camp, in my opinion. Where the parabolic SAR, it's either all bullish or all bearish, and it's turned back to bullish, positive. The money flow is still positive, and our 200 period moving average study, we're still above 50 there. And the financial sector is still coming back and showing some improvement that way. And then here's just an updated chart. No additional spike with the Hindenburg Omen here, but we do have a confirmation spike. So we're just keeping this in the background and in the back of our mind going forward from here. So our conclusion, I haven't changed this from after Tuesday's session. We're still positive and improving. We're supposed to be in a period of positive seasonality with the large caps and growth leading things and holding up fairly well. We're positive and improving in the short and intermediate term, and we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.